Good day, ladies and gentlemen. Today we are looking at what are indices. Right, so indices are a measurement of price performance of a group of stocks from an exchange. Rather than just focusing on the individual growth or performance of a singular company, indices allow you to gauge the overall health and strength of a market. Trading indices enables you to get exposure to an entire economy or sector at once, while only having to open a single position. Different indices track different groups of stocks. Our focus will be on the most widely traded US stock indices because those are the ones that we are trading 90% of the time. These include the Nasdaq 100, the Dow Jones Industrial Average, and the Standard & Poor's 500. So let's look at the Nasdaq. The Nasdaq is also known as the US Tech 100 or the US 100. That is how it appears on some of your MetaTrader 4 platforms. On different brokers, it will appear differently. Some will list it as US Tech 100 and others US 100. So do not be confused when looking for the instrument and you find that the name is different, right? So the Nasdaq reports the market value of the 100 largest non-financial companies in the US. The Dow Jones Industrial Average, it is also known as US 30, and it measures the value of 30 largest blue chip stocks in the US. You then have the Standard & Poor's 500, which is also known as the S&P 500 or the US 500. And this index tracks the value of 500 large cap companies in the United States. What affects indices? An index's price is affected by a range of factors, which include economic news, company financial results, and company announcements. Right. So let's look at economic news. You have investor sentiment, you have central bank announcements, you have payroll reports and other economic events that can affect the underlying volatility and cause the index's price to move, right? Under company financial results, we have individual company profits and losses, which will cause share prices to increase or decrease, which can also affect the index's price. You then have company announcements, and changes to company leadership or possible mergers will likely affect share prices, which can have either a positive or negative effect on an index's price, and that will cause the index's price to move. When trading indices, let's assume that you are anticipating that price will trade higher, right? Similar to Forex or trading any other instrument. When you're looking for price or when you're anticipating that price will trade higher, you want to be a buyer in the market and you will profit as the market goes higher and higher, right? In the case where you are anticipating price to trade lower, you want to be a seller in the market and you will profit from the markets as the markets trade lower and lower. We have reached the end of our lesson, and like every other lesson, we hope that this was insightful, and until we talk again next time, we are signing out.